ETFs have some common characteristics with both individual stock trading and with buying a mutual fund. A typical ETF tracks an index like an index fund, but is traded on an exchange like a stock. So an ETF is like buying a specific index, but instead of buying each and every stock in an index, you are just buying a single fund, which stands for the underlying stocks in the index. For instance, a Nifty-based ETF will have all the stocks of the Nifty, more or less at the given weightage of those stocks in the Nifty index itself. An ETF simply tries to mimic the overall movement of an index. If the Nifty goes up, the Nifty ETF tends to go up at the same rate and vice versa. Unlike mutual funds, but like for buying specific stocks, you will need a demat and broking account to buy ETFs. So for example, if you want to buy one of the most popular ETFs in India, called the Goldman Sachs Nifty Bs, you will place the order to buy these ETFs with your broker, who in turn will buy it from the exchanges. And once the transaction is complete, these ETFs will reflect in your demat account. But the underlying stocks of this ETF will be owned by Goldman Sachs, who is the sponsor of this particular ETF. Let's find out more. What are the positive and negatives of exchange-traded funds, if you can take us through that?
Many investors in the mutual fund, normal mutual fund, get a day-end NAV. If you want to exit or enter into particular situation in the market, during the day there might be certain changes in the market. As you see, the stock market, sometimes it fluctuates by -5% during the day and comes back to 5% plus during the end. If you are an end-day investor in a normal mutual fund, you get the end-day NAV. In an ETF, you can enter at any point of time, you can see the market, time the market, and just buy the units. That becomes one of the biggest positives. The negative side, if I say, the cons of ETF is most of the ETFs are primarily index-based. There is an underlying index which they track and try to reduce the expenses. So there is no active fund management. There is no value addition from the fund manager side. So because of that, you are always tracking the market return. You are not getting anything beyond the market return.
Okay. So you spoke about active management. So that brings me to my next question. What is the difference actually between other mutual funds and ETFs specifically?
The difference between ETFs and a actively managed fund is that it tracks the index. Suppose I am trying to invest in Nifty. I can either buy a Nifty future option or something. If you want to invest in for long term, you can buy a Nifty ETF. So the exchange traded fund is a typical unit listed in the stock exchange. You buy that. It follows the same proportion of ETF, and what it does is it can perform according to the market. The active fund manager does a lot of value addition. Out of the Nifty 50 stocks, there might be 10 stocks which are laggards. There are 10 stocks which might be outperforming the Nifty. Active fund manager will throw out those 10 and pick those 10 better ones, increase the allocation to them. In case of a ETF, you don't get that benefit.
And as far as the tax implications are concerned, what is it for ETFs and the difference between other mutual funds and ETFs?
As of now, the ETF's tax implication is as per the underlying asset. So if you are buying a gold fund from normal mutual fund versus a gold fund from ETF, the tax implication will be the same. If it is a debt fund, be it in the ETF category or normal mutual fund category, up to 3 years, there will be short-term capital gain, and above 3 years, it will be long-term capital gain. And similarly, on the equity fund, below 1 year, it is short-term capital gain, taxed at 15%, and above 1 year, it is taxed at 0 tax because it is a long-term capital gain. So typically, ETFs do not provide any extra benefit from tax point of view.
What are the kind of investors who should look at investing in an ETF?
Okay, this is very interesting. I see a big trend emerging worldwide. A lot of investors in last 5 years have been going for ETFs because people thought that the opportunity in the market is limited to create alpha because of a fund manager, and the fund managers haven't delivered extra outperformance in last 5-6 years. In India, since it is an imperfect market, that hasn't happened. In India, fund managers still do a lot of value addition by doing extra research. In case some individual investor goes to a normal fund, there is a minimum investment amount, a 5,000, 10,000, 20,000. In ETF, that is not there. ETF, you can just buy one single unit. If you got a demat account, you can just buy one unit of any ETF. Second is you get all the asset classes in one platform, a stock exchange platform. So you can buy gold, debt funds and equity and ETF. But primarily ETFs are good for institutional investors. For retail investors, they still need assisted advice. They should get some help in selecting the asset allocation, selecting the underlying scheme. In ETFs, because it is real time, many times advisory is not there.